Hello. Okay, good. Good. Thank everyone that didn't go and get a coffee. We have a break after this, so you will be able to go and get a coffee when we're finished. But for the next hour, we're going to be talking about the affiliate landscape, what it's going to look like post M&A. And to do that, we've brought 5 of the biggest affiliate companies and investors in the space to come and discuss that. Just to mix things up, I'm going to walk around with this microphone and I'm going to take questions for any panel member at any time. If you weren't here earlier, my name is Michael Caselli, and allow me to introduce our panel. On the far left, we have Marcus. He is the head of corporate development and M&A at Catena Media. To his left, we have Charles Gillespie, the chief executive of Gambling.com Group PLC. To his left, we have Michael, who is the head of M&A at Better Collective. To his left is Julian, who's the co-founder of RB Capital. And to his left, finally, Johan is the founder and chief commercial officer of RigTech Group. So, ladies and gentlemen, a round of applause for our panel to start, please. Now, since we're talking about M&A, I first want to ask the audience a few questions so that we know what we're dealing with. Is there any affiliate here who works on his own? So you're an affiliate, you have no employees, and you just do your own thing. We have one. Good, okay. Do we have who here is with a company, an affiliate group that has between 2 and 10 employees? 2 and 10, okay, 2 and 10. And who is 10 to, let's say, 50 employees? Okay, anyone with a group that's over 50? Okay, good. So we have a various sizes. This kind of gives us an idea of what the landscape's going to look like in the M&A space. Gentlemen, after this show of hands, tell me, what is attractive to you looking to do mergers and acquisitions? Are you looking for one-man band? Are you looking for bigger companies? What is it that you're looking for when you're on the buying trail? To all of the panel, please each answer in sequence. Do you have microphones? You have 2. Note to self, increase microphone budget next show.
Yeah, for Catena Media, we generally look for high growth, high margin, and it should have revenues of above 100k euro a month. That's where we are. For us to look at smaller, it has to be a very strategic play, because the integration, it's a lot of effort to do the integration, the different CMSs, etc.
What about small companies that are just highly effective, that are bringing in numbers like 100k a month? Do you mind if it has 10 employees rather than 100?
Rather less than more.
Rather less than more.
Yeah.
I would echo all of that. It does take work to integrate all the acquisitions, so you want to make sure that you're doing stuff of sufficient size. If you do a bunch of small deals, you're just going to, it's going to be basically the same amount of work. If you buy something that does 25,000 a month in sales, to integrate that, it could be a similar amount of work as buying something that makes 100,000 a month in sales and integrating that. So you might as well just do the bigger deal. So from our perspective, we've always tried to do kind of fewer, larger deals, just to minimize the amount of integration work involved. But we also look for regulated revenues. We look for things that would be relatively straightforward to integrate. So if we had an option on a group of, let's say, 20 websites that made 100 rand a month, or one website that made 100 rand a month, well, it's a lot simpler to just buy the group that has the single website as opposed to the 20 websites. So there is attractiveness in simplicity and assets which are not too complicated.
Michael?
Yeah, for Better Collective, we're probably a bit more flexible, so there is not such limit like you mentioned of 100,000 euros a month. So we're looking at exactly what Charles mentioned is how easy it is to integrate those businesses, and also what potential they have, what revenues they bring in, if it's regulated, unregulated. So there is a number of questions we need to answer, but in general, I would say we're a bit more flexible to what you mentioned.
Julian.
We have a slightly different perspective. RB Capital mainly focuses on the sell side of a number of assets, and there's always going to be a buyer. It just depends on where you look, how you look, and indeed where the market is at the moment. If we had to buy, we'd buy assets up to 1 million, normally in early stage or what we call special situation, because then we can convert it, we can flip it, we can turn it into an interesting asset. But then on the sell side's a bit more interesting. If you have an industry or an affiliate that's pulling 10K a month, that would be very interesting to a specific operator. We just sold an asset which had a net profit of 0, but it had something very lucrative. It had a German license. And people are looking for German licenses right now. So there's always going to be something which is in the eye of the beholder. The question is, you need to position it properly, you need to have the right messages, and you need to be truthful and upfront, if that makes sense.
It totally does. Johan?
Yeah, from Raketech, size is always important, like my colleagues have already mentioned, but also the synergies is very important. How could we migrate this into our core business? Also, we always look on the founders behind the companies. What could we benefit from them in the migration to Raketech's business?
Charles, you mentioned you like to go with an operator with one site is better than an operator with a number of sites. You have a very large number of sites that are very large, kind of big Hollywood sites. You've got obviously gambling.com, a couple of betting ones. What are the betting URLs again?
Yeah, so we did a deal in February where we acquired bookies.com,
right,
as well as footballscores.com and bookmakers.co.uk. That came with a number of premium domains as well, such as freebets.net and bookmakers.com, which will be pretty much ideal assets to move into the US if everyone gets this favorable Supreme Court ruling that we're all hoping for.
Interesting. So do you think you're in a somewhat unique position on this panel in the sense that you guys obviously go for the premium domains as a part of your bigger strategy rather than going for quantity?
Yeah, I mean, that's very much a core piece of our kind of strategy. We acquired gambling.com in 2011. At the time, it was just a domain name acquisition. It didn't actually generate any revenue. The first 2 months we had it, I remember it produced 1 NDC. So when we got it, it was producing 1/2 NDC per month. Now it's one of the biggest sites in the industry, quite well regarded, very good brand. We've put that on TV in the UK. If you want to do kind of more mainstream advertising, you need a brand that people are going to be able to remember and be able to plug into their laptop or smartphone. If the domain name's too long or too complicated, it's just not going to work on radio or TV or in any of these kind of more traditional branding type media places. But yeah, we like the big brands. We think it creates kind of instant credibility with visitors to the website. If you land on bookies.com, presumably there's some sort of operation behind this that's built a proper asset, and you don't get that if you have less quality domain names.
Is anyone else trying to follow this strategy, number one? And my second question, even though we're at the Nordic Affiliate Conference, is anyone else on the panel making acquisitions in anticipation of the opening up of the US market?
Yeah, I mean, we have the biggest affiliate there, and we have the second biggest now. So we are big in the US, and we have a few things that because the markets will open up, Pennsylvania this year.
What's the biggest affiliate that you have? I presume you mean in New Jersey.
New Jersey and Nevada.
Okay.
So I mean, there are a few domains, but we have Poker USA, Play NJ, Play USA, okay, and Bonus Seekers. They are the biggest.
Okay, and you're mentioning Pennsylvania.
Yes, so that will open up this year. It's unclear when, but it's probably going to happen during Q3. So we're expecting that to be a big. I mean, the problem there is the taxation is very high compared to New Jersey. But because we're there and we have some sports domains that we are ready to launch, like our colleagues.
So these are kind of started out as small underserviced markets. So if we're at a Nordic Affiliate Conference, we might compare that to, let's say, the Icelandic market. In that situation, did you acquire these affiliate sites, or did you go and build your own from scratch?
No, we bought the core, and then we built a few. And then we bolted on a few as well, like Poker Scout, for example, which was a not really revenue-generating domain at the time, but it's a perfect fit for us to work within our kind of domains and backends.
Also a cool site, like Poker Scout. Johan, you wanted to add something to that, what you're doing for maybe US preparation?
So far, we haven't done any operations in US, but we have acquired some really good assets, unused domains, which could be suitable for when we see more states opening up.
In the audience, again, by show of hands, is anyone here on looking for unused domains or looking for expiring domains? When you find a URL that you want, do you then put your email in and say, "Let me know when this is available," or not? By show of hands, who's going after expired or unused domains? Yeah, you're always looking, always on the hunt. You probably have about 1,000 domains or so sitting around. I'm the same. Yeah, I'm about the same. I have like 600 domains that I just keep acquiring all the time. Try to sell to these guys one day. Okay, so we brought up the topic of going into a new market and whether we should be looking to whether we should be acquiring or building or a hybrid of both. I'd like to hear those opinions, especially since that we've heard earlier that there's a hope, a glimmer of light that maybe one day Norway may open up. And maybe this will be a market which is, again, not dissimilar to what's happening in New Jersey, in Nevada, and in Pennsylvania. In a market like that, are you going to be looking to come in and acquire, or are there not big enough affiliates to bother, so you'll have to go in and build? To anyone.
So for us, we have Norwegian sites. So for us, if it's a really fast-moving asset that really adds something different, we will definitely look at it. But otherwise, we're quite strong in Norway. We could be very strong in Norway.
That's a better, the safe way to put it. We could be.
We do have a few Norwegian sites as well. We have a Norwegian version of gambling.com, but it's a tiny part of the business. And before we invest substantially more into that market, we would wait and see how things develop in terms of regulation.
Yeah, I think it wouldn't be smart to ignore markets like US or Norway. So obviously we also looking at those markets. For Better Collective, it probably is also a bit different story. We started acquiring businesses probably 1.5 years ago, something like that. So we historically are strong with growing organically. So that's also one of the main focuses for now for us. But we obviously also looking for acquisitions in those markets that you mentioned.
You seem to have a lot of user-generated content, right? You've got the bookies and things giving advice, and you've got a product where you could follow your favorite bookies and bet with them. Is that correct? Is that a strategy that you could roll out effectively over and over again? And does that strategy limit your ability to acquire some of the other operators in this room who don't follow a similar strategy?
Well, obviously, it's not an easy job to build the brands like Betting Expert that we have with 100,000 of tips from user-generated tips. So that's an asset we're very proud of, and we working on that in the multiple markets. But obviously, there's not that many companies that can compare with that. So it's, I would say, almost impossible to acquire similar businesses. So what we definitely looking to expand both Betting Expert and building new products like Smart Bets that we recently launched and is enjoying some good growth all the time with that is giving something more to users than just some articles, bonuses, reviews, and so on. So that's obviously, apart from doing M&As, it's our heavy focus to grow our products and brands.
Julian.
Just to add onto Mihal's point, there's some developing stories, particularly in Norway, around very good sites that are gradually building up domain authority. So they become of interest, particularly from an affiliate's perspective. So we're starting to see that. And conversely, we're also seeing buy-side interest. So we're starting to see some of the bigger players start to inquire with us as to what there is in Norway. It's going to happen. It's just a question of sitting on the right asset, making sure you're building up your SEO profile, making sure your link backs are there, and then jumping on at the moment you start to see a green light from the regulation.
Johan, last night at dinner we talked a little bit about Norway, or after dinner we talked about Norway, and you had an interesting perspective. You see, I've always been of the opinion that, well, I guess we're never going to see the Norwegian market open up, and we actually even see them cracking down a little bit further. But your point of view was slightly different. Can you share that with the audience as well?
Yeah, I think it was quite interesting yesterday to see how the government, how they declared this. But hopefully, this is the first step to get Norwegian re-regulated.
So you think that they'll tighten up regulation, clean out the market a little bit, and then go and let some operators get involved?
Yeah, that's my picture of it.
In the last session, gentlemen, we heard, and it was controversial slightly, that regulated markets then create opportunities for M&A. I don't know where I stand on that. There were a couple of good points made on both sides of that argument. What do you think, as people who are actually doing the mergers and the acquisitions, mostly acquisitions, about that statement? When we see markets more heavily regulated, are you more interested in them or less interested in them?
There's definitely more interest in regulated markets. That's without a doubt. The amount of buy-side interest you see in territories that have just become regulated is phenomenal. But you also see a lot of demand for grey market territories, not just because they're not regulated, but also because there's a good fluidity of players from other territories coming in. And you start to build up what essentially is a very lucrative player database that at some point is going to be worth something to someone. So yeah, regulated territories, definitely more buy-side interest, particularly from the more publicly floated companies, for obvious reasons. But don't underestimate the unregulated markets or loosely regulated markets and the demand for them.
I'd like to hear everyone's opinion on that, if they differ.
As a market regulates, it kind of unblocks a few things. If you're talking about 10, 20 million euro deals, the acquirers are pretty serious about this stuff. They don't want to make any mistakes, and it's less likely that you would make a mistake buying a regulated asset than you would buying an unregulated asset. The multiples also you're going to see for, the multiples related to the valuations for regulated revenue and regulated assets are going to be higher. So that might also convince people to finally sell. So I don't think it's like some sort of magical key to additional M&A when a market regulates, but I think it's generally a positive thing.
Yeah, for us, it has to be regulated or soon to be regulated. It can't be a dubious market. Then we cannot look at it, for example. So.
Good, Michael.
Yeah, I think in my view it all depends on the regulations, but for example what we saw in Romania where we acquired one of the biggest affiliates, the regulation does affect the businesses operating there. So it's a small example, but 6K affiliate license in Romania on top of some company structure that you need to introduce to be a professional affiliate, licensed affiliate, it leads people to at least to think about, well, okay, should I continue my business or should I look to sell? Maybe that's the right moment, and the interest from buyers, as you also mentioned, is there in the regulated market. So I believe that regulation does boost the M&A activity, and that's not only in the affiliate industry but also in the operators industry.
Julian?
I think that makes sense. Charles mentioned a good point. Once you're in a regulated territory, it's almost a push for an affiliate to want to sell. It's almost like the time is now. When are you going to call peak valuation? And I think, yes, it does work a lot on regulated side. But then equally, you also need to make a good call. When is the right time to sell? And the right time to sell isn't necessarily when your business or your territory that you operate in gets regulated. You need to make sure your KPIs are good. You need to make sure your business is readily integratable with the prospective buyer. And importantly, and Charles hinted to this as well, valuation is very tightly linked to how your business is going to perform, not just now, but also over what is known as the earn-out period as well. And that's actually not necessarily just 3-6 months. It can be as much as 2 years, potentially even more as well. So calling what is essentially peak valuation of your business is actually quite delicate. And then you throw in regulation on top of that as well. Yeah, it's a very complicated landscape.
So what is the process then? You're looking, I'm here, I'm an affiliate. I'm looking to get my highest valuation, my peak valuation. What do I do? Do I come directly to you? Do you come to me? Do I find a broker? What's the first step when I've decided that now is the time to exit?
You send an email to charles.gillespie@gambling.com. I think if it's if you're, it's pretty obvious who the buyers are, right? So it's not so difficult to make a few basic inquiries to gauge initial interest. So I think it's a fairly straightforward process if you're reading the news and see what has been happening over the last couple of years. But just to Julian's point, I'm very happy to hear that valuations have peaked and.
Yeah.
Well, so do you want someone to come to you directly or through a broker, ideally?
Let me give the broker's perspective.
Good.
I would say if they come directly, it's quicker and easier.
Bad news,
And
Julian.
you don't,
And cheaper-
you don't
and
have-
cheaper
For
as
us,
well.
you don't have to do an IM or, we can do it very quick and very efficient.
What,
I'd have to second that. It's just it's just a more straightforward process. We do this all the time. We know how to do this. It is typically easier.
Charles, you gave me a different answer to that a few years ago. You said you liked when brokers came because it was more professionally presented to you. What's changed?
Did I say that?
Yes, you did.
He's paying more for it now.
Have the brokers gotten too greedy? Has it just upped the game too much?
Well, I mean, look, there are benefits, right? If it's if it's really packaged up nicely, it can make it an easier process. It would depend on the circumstances, but it's not necessarily a bad thing in every circumstance. But we're eminently capable of doing these deals without a broker.
And I think it's the most important is to listen to the affiliate who's going to sell their baby. What's important for them? What do they like to see on a deal? So all these, the deal structure could differ a lot. From Raketech, we've done 19 acquisitions in 3 years' time, and all deals has been different to each other. So maybe a broker doesn't have only like to maximize the revenue, but we really like to listen to the seller, what they like to get out from a deal.
Julian, I'd love to hear your probably opposite perspective.
It's actually much more aligned, to be honest. I think brokers don't necessarily inflate the value of assets. I think it's more about aligning it with what is the buyer's expectations, especially if you're working sell side. You'd be surprised how unprepared most affiliate assets are before they go down a process. People haven't thought about tax structure, people haven't thought about the way revenue is collected, people haven't even thought about rev share versus CPA. So you'd be surprised that almost there's a very strict due diligence check that buyers are going to go through anyway. And what happens from a buyer's perspective is the moment they see that, they start knocking off points off your valuation. So I think in many ways, evaluating a business needs to be done, in any case, from an affiliate's perspective. You need to keep your body in check. You need to keep your business in check. You need to keep your whole life aspect in check. Why not do it with your business as well?
I love that we're giving life advice.
Hey, always. But I think in a way, to Charles and Marcus's point as well, if you go directly to a one buyer, what happens is you don't know the value of your asset. You're only as good as what the market, as opposed to one buyer, is prepared to pay. And if you only have one buyer, then there's no market. It's as simple as that. Now, sometimes it complicates the process because you need to go through what is known as an IM, an exclusive stage, a due diligence process and whatnot. But almost inevitably, at least in all the cases RB have done, the value of the asset sale has always been greater than what the affiliate would have been able to achieve for themselves. And I think that actually is a testament to saying, do your homework right, do the market work right, and your research right, and then the market is prepared to pay for a good asset, if that makes sense.
I mean, I've helped
To be honest,
affiliates get on that.
We worked with RB, and they actually, on a few things, they wouldn't have happened if they weren't there. So let's say, if you're super disorganized, then definitely go for an advisor, because we will require some information, a lot of information, and depending on the complexity of your business.
Yeah, and
so it depends.
I'd repeat the same thing. If you understand kind of finance and business and M&A at a kind of basic level, due diligence, legal stuff, you could probably handle this yourself. But if you're totally clueless, if you're really just...
That's a bit fucking harsh, isn't it? If you're totally clueless, like,
I mean, if you're,
most people here are really good at SEO, you know.
maybe you're a mad genius SEO and you're making 500 grand a month, okay, but you don't have enough time to figure out the business side of your business. Then in that type of situation, it would probably make sense to get somebody in. They can actually package things up for you and hold those conversations for you.
So it's, I mean, so there's a checklist to do. And that checklist would include, if you have technology, documenting and commenting your code. It would include getting your business plan together and looking at what you think realistically you'll achieve in the future. You'll want to look at trends of what you've achieved in the past up until now. And I think those are the kind of the things that, Julian, you're probably helping put together, and gentlemen on the stage, you're probably expecting to see before you start knocking off those points Julian talked about, where you say, oh, you don't have your code documented. Oh, that's knock off 100K. We're going to have to do that for you. So I guess it's those kind of things that if they came prepared, you'd be kind of ready to go and say, okay, we could snap this up pretty quickly. Is that fair?
I mean...
More of a checklist than needing a broker?
The vast majority of the M&A that has happened over the last couple of years is for fairly basic SEO-based assets, which are running almost every single time on WordPress. So the technical challenges of understanding these assets are not usually that high. Sometimes there's more complexity, sometimes there's live data feeds, there's like an actual product, Betting Expert, Smart Bets, those are not simple WordPress sites. Those are very complex products which have taken years to develop. If you were buying something like that, not that it's for sale or anything, but if you were going to buy an asset like that, the technical due diligence would be critical. It'd be very important. But if you're buying just kind of a bread and butter SEO website running on WordPress, we all have existing teams which are probably going to take those assets over and run them in our own particular ways. So the technical due diligence in such a situation might not be as important.
I think in the past we had cases where affiliates were sending us screenshots on their affiliate accounts on Skype. So then I would love, Julian, to deal with those people and manage this process for us. But in general, it's obviously up to you as an affiliate. But if you have a, let's say, proper setup as a company and you collect your data, you have some documentation on it, then obviously you're probably able also to do the process yourself, so obviously it's up to you.
Yeah, I think that's right. And look, preparation is going to be key, because you'll always be surprised. You never set up a business initially with the view to sell it. You do it because there's love, there's passion, there's money to be made, you want to grow your business. It's a chapter in your life, and it's important. You want to grow it, you want to enjoy doing that. At no point do you think, shoot, my tax perspective is actually not good, or I really should be thinking about an asset sale, not a share sale, because that's going to influence who my buyer is going to be. So actually, once you go through that process, that's actually really long. It's not a 2 or 3 month process. Sometimes it can be 6 to 9 months, potentially more, particularly if you're redomiciling. But to Michal's point, there's a lot of business that we turn away because we actually say, you're not ready yet. You're not ready yet to go through a process. You don't have your accounts in order. You don't have the process that somebody would look at you and actually say, you're a growing perspective. You need to have these things in place. You need to be able to put this strategy in place. You need to look at your link back strategy. You need to look at what your SEO is doing and where your domain authority is at. And to Charles's point, sometimes your tech isn't actually quite good. So it actually becomes less of a commodity play and more of a distress sale, because you're using .NET as opposed to a LAMP stack, or you're doing something that no buyer would want to touch you on. So you'd be surprised around all the different aspects of preparation that go through an M&A. And to be honest, the more about this is ready, the easier it is for a buyer to accept all that work and then integrate you quickly into their business, if that makes sense.
That makes a lot of sense. And I mean, that kind of brings us back to the question of, so what are we buying? Are you buying... what are you valuing things on? Are you valuing it on, I know there's a number of aspects, but are you valuing it on the uniqueness of a technology provided it's built correctly? Are you going to use a standard valuation based on revenue, a standard valuation based on profit, a standard valuation based on some other KPI? So when Julian's probably a good person to answer this, when you're trying to sell a business, what are the KPIs that you're trying to make look outstanding in order to get the best peak valuation for these companies?
So there's a few textbook ones that need to be there. You need to see your revenue and your growth perspective. You need to understand how efficient you are in converting that revenue into actual net profit. That much is key. If you don't run your business like a tight ship, and normally the smaller businesses tend to do this really well, then you don't necessarily have an efficiently growing business. We mentioned regulation. Regulation is key. Are you operating in regulated markets? Because that, as Charles and Marcus said, that is going to increase what is known as the multiple. Now, what is this multiple? Multiple is mainly what essentially is a multiplication on your EBITDA. It's not on your turnover, like finance and real estate companies do. It's mainly on the bottom line, because the bottom line is what money you actually can convert successfully once you've run your PPC campaigns, once you've run your development profiles and whatnot. But that's just the start then. It's how efficient is your tech stack? Do you need to pay high costing and hosting bills? Is it uniquely there? Do you have any domain infringement issues? Is somebody coming after you for copyright? Have you been penalized by Google lately? Are there any other issues with regards to potential SEO infringement? Is somebody actually blacklisting you or black hatting you or negative SEOing you? All these actually factors are essentially implicit over and above the top line figures. And then you ultimately come down and you break down to what essentially is a range. And in that case, you're actually pretty close to what the market is ready to pay. But unless you have one or two or more buyers in the field, you will never be able to price your asset correctly. And that's why you actually need to have what essentially is a proper due diligence but discrete process. I'll hand over to you guys, because you probably have different opinions to this.
Well, that's actually hugely specific and accurate, and it makes a lot of sense. And I'm wondering from the rest of the panel, if you actually get into that level of detail. I mean, it's hard to find out things like, are you being negatively SEO'd? It's hard to analyze anyone's code and see if it's perfect. Do you guys get into that level of minutia during an M&A, or are you in reality working on KPIs that are more simple?
Oh, for us, we do a deep SEO analysis, so due diligence where I check all the backlinks. They created a tool so they can see if there's been any penalties or any bad backlinks or any issues with SEO. I mean, you can't find everything, but it gives enough. But otherwise, I would say make sure you have a legal entity that's not in liquidation. This has happened more than once, where we're trying to buy the asset and they forgot to file all the accounts and taxes, which creates another hurdle that will take a few months to sort out, because obviously the liquidator is not going to release the asset. And so just make sure you have your house in order. The growth, we will probably look at 3-4 last month, if you have growth there, and what your profitability, because looking back further is no point in this fast-growing industry. But we do, those are the checks we do, and what we're looking at is profitability, growth, what type of asset is it, and who is running it, because you'll be working with us for, hopefully a year or two or longer, because we obviously need to grow our business as well, so yeah.
How long are you keeping the management generally when you make an acquisition? And are you keeping the entire staff typically, or are you generally cutting the staff and providing essential services centrally through your larger companies?
That would depend, obviously, on each deal. Most of these deals involve an earn-out, which was mentioned by Julian. So, you would get some amount of money at close, and then you would get probably a second or even a third payment based on performance over a period of a year, 2 years, or whatever you want to try and agree. During that earn-out period, you are highly, highly incentivized to deliver. So the sellers of the business would, of course, stick around and would be, in theory, very committed to hitting their numbers during that period, because it's simply going to have a major economic effect on the total amount of money they would achieve through the deal. So in cases like that, the motivations are quite clear. You don't necessarily have to bring the people on as full-time employees, or there's different ways to structure things, but it is key that the management remains committed to the business during that period.
Johanna, you wanted to add something?
Yeah, obviously the seller knows their business best, and we acquire it, but they know the business best, and we always try to listen to the seller. Do they like to stay on board? How could we structure the deal so they can stay on board for some time? Also, if they stay on board, the risk is lower for us as buyers. So, but I think most important is to always listen to what the seller prefers.
Michael?
Yeah, so from the deals we've made, it was always a discussion between us and the seller, and in most cases we actually just found a common agreement that in some cases the seller wanted to go out pretty fast after the sale, and in some cases where we were acquiring bigger companies with people involved, then we kept the offices and most of those people at least. So it's a subject to discussion because every business is different, and there are some businesses we quite easily can integrate in our offices across Europe, or there's some businesses that we might need the support from the seller, and that's not depending if there is an earn-out involved or there is a straight deal. It's just in some cases you need more people to manage, especially the bigger businesses, and if you keep those people, it's also a bit easier to manage and grow the businesses.
But it does affect the sale price. I mean, this goes back to your main headline question. I think post the initial sale, as Charles hinted, there's a few stages that happen. A is what is known as the earnout. Is this an upfront cash sale, or is this going to be what essentially is a deferred or an earnout series that really affects the overall sale price? The second is this cash or is this shares, or is this a mixture of both? Because we do see a lot of, not just in gaming, but particularly in Forex and in prop tech, where there's massive numbers and massive valuations and multiples, but then it ends up to be a 70% shares, 30% cash, and sometimes very little is traded up front. But it's good for share price, and it's also very good for investors as well. And then the third is, what is your headcount cost? What's the cost of your human capital to continue keeping the lights turned on after that business is run? And that goes back to make sure your business is really efficient in the beginning before you start the sales process, if that makes sense.
Makes a lot of sense. Now I'm walking around not just to keep myself occupied, but because I wanted to get questions throughout this little session. Does anyone have any questions at this point? I'm not going to stop and ask you all the time. If you do have anything to add or ask for any of these topics, just raise your hand, because that's kind of why I'm out here. Yes?
When you guys talk about earnouts, is there a risk of keeping on a previous owner and they have incentives that don't match necessarily your outlook and growth in the company, and they're doing really what they need to do to maximize their earnout, but it doesn't help you guys, for instance?
Yeah, you try to anticipate all of those scenarios in the beginning and make sure that you don't have an awkward situation. But you could have a situation where people basically are too aggressive on the earnout. They do things that are bad for the overall business. They sell advertising at prices which are unsustainable or not sensible. Or they start targeting seriously dark markets. Maybe all of a sudden you bought a business which is big in the UK, but it's big in Turkey 2 years later. That wouldn't really be what you were trying to achieve. So you've got to try to anticipate those issues in advance, and by and large you can. I haven't really heard of any controversial earnout situations in the industry in terms of the affiliate side, really ever.
I would say so far we've been, I guess, lucky, but it's been aligned. But what you find is that when someone wants to sell, it's easy, and then when the asset is supposed to be handed over, it's like taking their baby. So then it becomes a bit stressful, and then they work really hard for 3 months, and then they kind of slowly fade out, and then they work through the earnout, and then they don't want to stay. That's what we find. And some people are corporate because we're all fairly big companies, so it's a corporate structure they will go into, and most people are entrepreneurs from their early age. So the fit at the end, after the earnout, it might not be there.
The culture clash.
Culture clash. But there are always positions in companies like these. We have 60 open positions at the moment, so there's plenty of room to grow in the companies too.
Sure. Julian?
One of the best quotes I heard from a seller was that we're actually going through that process now. He said, I don't care who the buyer is, I don't care how much the buyer wants, I just want to buy a bigger boat. And you find that they tend to be the exception, not the norm. You just find someone who's essentially built a career out of what essentially has been their business. At some point they want to cash out. They don't necessarily care. They're just seeing the Fiji Islands on the horizon, and they just want to get there. More often than not, the founder has some very specific and very opinionated ideas about what they want to do with the business, and they are normally very conducive to what the buyer wants to do anyway. So it's just about finding what essentially is an incentive plan for the founder to stay on in some capacity as a consultant, chief scientist, chairman, or even just a spokesperson throughout the earn-out period, and then find some way that both parties are happy with the end. Because it is a win-win situation. The buyer is getting a really good asset, and the seller is getting some good money. So at some point, because there is love in that room, you can definitely find a solution.
How hands-off are you all when it comes to the earn-out period? If not Julian, but everyone else. Do you let the entrepreneur go and do what he feels like is best for his company to control his own earn-out, or are you guiding his hand during that period?
I think during all earnouts, it's what we've seen be very successful for us is to have a common goal with a seller, that we do a strategy together. This is what we like to reach during the earnout, and yeah, we're happy to pay up if they follow that and don't only go out and try to maximize the risk, because SEO could be a lot of risk, especially if you try to just boost the traffic short term. So to have a common goal been something we've been focusing on in all earnout deals we've done.
I'm making assumptions that this is a buyer's market. Is this a buyer's market or a seller's market in the sense that you guys also need to do a beauty parade? If Julian brings each one of you the same asset, how do you convince the asset that you're the right direction to go in, given that a portion of what they're going to do is going to be based on their future earnings? I mean, Johan's going to tell you that there's a common goal and you need to achieve it, and he's going to work with you on that. Is that everyone's strategy, or is there are there other things to consider when I'm choosing someone to sell to?
So I can start from the broker's side. So this is not specific to gaming. This is more the way the industry works. And in fact, it's a question we probably need to talk about. Are we really post-M&A at the moment, or are we in the middle? In general, if you just have one buyer for an asset, it's a buyer's market. If you have more than one buyer, it's a seller's market. Why? Because the market will dictate the price. That's as simple as that. And it also goes back to the point that if you go directly to a buyer, then you don't have a market. You just have a person-person relationship, which probably works, but you aren't necessarily getting the true value of your asset. Now, right now, the way we...
Well, yes and no. You also have multiple sellers in this situation. So, right, if I am not nice to anyone that wants to sell to me, eventually someone's going to sell to me anyway.
Well, I'd just make the same point. I think it's kind of a buyer's market and a seller's market, because you do have obviously multiple buyers that are active, but there's a lot of stuff out there that's basically for sale or could be bought. So it's not, you haven't seen things meaningfully change in the last couple of years. Valuations have stayed at the level they're at. There's still plenty of things out there to look at.
And to Charles's point, the valuations and sale prices have remained roughly the same because there's still demand on both sides. The big players need to continue growing. They normally do through acquisition. There's only so much you can continue growing if you are top of the list, because there's only one direction to go, so you need to continue buying your way. And this, again, is not specific to gaming. This happens across all industries. Regulation or non-regulation or issues with specific territories always kind of rocked about a bit.
Right.
But then in those, you see opportunities, which is why you get to see issues like, or opportunities like German legislation, Australian legislation, ASO. There's a number of aspects that if you time the curve properly, it becomes a seller's market, because there's a lot of interesting assets that buyers can buy at what essentially is a low price. But then you have a lot of sellers as well.
Let's give it some scale if we're talking, moving into this question of if we're in a post-M&A market. Can each one of you tell me how many businesses or assets you've acquired in 2016? Go ahead, Marcus, why don't you start?
11.
11.
We've done 4 deals, 2 this year, 2 last year.
Well, if you're asking about 2016, we did 0. Last year we did 8, 2 already this year.
And Johan?
2016 we did 5, and last year we did 9.
5 and 9. And Julian, you've sold something like 330 million worth of deals.
That's the overall deals.
Overall deals in other markets as well.
Yep.
Okay. Now, this post-M&A question. So you've acquired a lot. Michael, you've mentioned you've not done any deals this year yet. Charles, you've done 2 this year. Are we getting to a point now where it's more difficult to find suitable acquisitions in the gaming market specifically?
Well, I think it's still possible, and obviously we are interested in acquisitions, and I don't think any of us gonna stop this anytime soon. But at the moment, I believe it's still possible, and what we also seeing is that the world is pretty big, and there's a lot of markets and a lot of companies across those markets. For example, US opening up, there's will be new affiliates popping up there. Norway regulating, new affiliates will be coming there, and there's always new affiliates coming up, doing something smarter, better in the SEO or social media or any other channels, and they do grow. And obviously, we still interested in those companies, and it's an ongoing story, and I don't think it's gonna stop in anytime soon.
And also new territories and new products open up as well. There's a growing interest in esports-based affiliation. We're seeing a lot of app store optimization, so affiliates that specifically target app stores because of the search intent for users. So it isn't necessarily just territory limited, it's also product-based opening. So it's actually quite interesting, and if you're an affiliate, you stay ahead of that curve anyway, so you kind of know what to get to.
I would say the trophy assets, which we all are after, they are few. But in general, in the affiliate market, there are lots of opportunities. But the trophies are few, and we're all hunting for those.
Now, when you're looking to buy something big, are you guys looking to bring in outside funding oftentimes? Are you looking to go to the bank and say, listen, I'm going to buy this thing for 40 million, 50 million? Or are you guys trying to self-fund most of your acquisitions in this year and beyond?
I think due to the scale of a lot of these deals and the business plans of these companies, it is essential to bring in outside finance. We raised 16 million last year. You guys have issued bonds for 100 or 200 million now. So it's the cash flow. You just can't do as many deals as you would like to do off of pure cash flow. You have to look at outside finance.
And given that you're looking at some outside finance, you all started out gaming specific, but now we're talking about esports and casting a much wider net. I imagine that the people that are financing your businesses want you to be less sector dependent. Is my assumption correct? And if so, what other sectors are you looking at? And if my assumption is wrong, then why are you looking at other sectors?
I think the financiers are not, they like it. They are in the sort of gambling space because they like it and because of the returns and the growth. But I think from a business perspective, we branched out into finance affiliation, because it's regulated everywhere. You don't have to worry about not regulated or regulated. It's a lot of angles on it, and you can do more global brands. So that's more of for a steady business to have a bread and butter part of the business.
Makes sense. Charles?
We changed the name of the company to Gambling.com Group last year. So if we're going to go into anything other than gambling, we might have to.
It was
change the name
called
of the
Cock
company
Media
again.
before that anyway.
Sorry?
Wasn't it Cock Media before anyway? I mean, it was a good change.
Cax Media.
Oh, sorry. Good change, though. I just got that mixed up. I used to write it on bathroom walls to advertise you.
Yeah, the new name's a bit better. We were trying to remain somewhat low profile with the old name, and obviously a little more higher profile now with the new name. I don't have any problem with going into stuff that's not gambling, but it's certainly not a priority of ours. We're hiring aggressively just to run all the assets we've already acquired. We've just leased a new office, and I've got room for another 50 people in there, and I'll fill that up, and still probably need more people just to run the gambling stuff we have. So we're in no rush to look at non-gambling things, but I don't. At the same time, it's the exact same skill set. It's the same model. It's the same technique, same process to be a successful finance affiliate as it would be to be a successful gambling affiliate. So they are very, very similar.
Michael?
I think from our perspective, obviously we're still focusing on the gambling market, and if you're looking at the acquisitions from other verticals, let's say, you're probably looking at the less synergies that you have in the businesses that you very common with, like sports betting or casino affiliation. Then it's add another layer on the valuation, and probably quite often the valuation will just not be the right valuation for us. If you're going somewhere outside, you need additional resources, content resources, tech resources, maybe some new providers and so on. So it's getting a bit complicated, and it's also distracting you from your core business. So it's not necessarily something we would like to do. And even if we like to do, then it's maybe the valuation is not there to match our expectations.
What we see in Attractive is hybrids, product which is not 100% gambling advertisers, where you can have, like, we have our guides, the TV sport guides, very popular in Sweden, Denmark and Norway. And now we see, we both have gaming companies, iGaming companies, and also we have all the TV channels, and we have big like sport, like Nike, Puma, who advertise. So, example, now in Norway, some of the casino assets, pure casino assets, they will lose most of the revenue if this go through, which the government said yesterday. But for us here, we still keep some revenue since we still have all the TV channels and other kinds. So hybrid, especially when it comes to guides, is very, very attractive for us.
It's hard. It's hard for any affiliates in this room, I think, to really go for a hybrid model most of the time, because like you said, the gambling revenue is much more valuable than having a Nike advert where they're buying, you know, crazy numbers for very, very, very little money. Julian, let me ask the opposite question. So in this room are most of the people that acquire gaming sites, and they're all very gaming specific and gaming specialist. Outside of the gaming industry, are there other industries that are looking at similar acquisition on the affiliate or performance marketing side? And are those industries looking at diversifying and acquiring gaming assets? So can we cast a net wider than the obvious few that we discussed earlier?
So until a few years ago, yes, absolutely. I mean, payday loans and affiliation were incredibly big.
I'm kind of talking about the opposite, actually. I'm saying that are there... Can we go to sell in another industry, in another sector-specific company?
Yes, but you won't be getting the same returns. Absolutely. I mean, apart from finance, because finance, and again, in certain areas of finance, you actually need a finance affiliation license, but mostly speaking, finance seems to be the more lucrative one. There's emerging interest in PropTech or PropTech-based platforms. So essentially, I put an investment on what essentially is a platform that then sells my investment on to buyers and letters. And now there's also investment trackers as well. So I can actually put my money on what essentially is a crowdfunding platform. And because that there's a CPA or a straight CPA as a result of my deposit. And my deposits don't tend to be $200, they tend to be $2,000 or $20,000. So there tends to be quite a good lucrative development there. It's very limited because it's early stage, but the dynamics are the same. And technology has finally matured to the point that you can actually track very actively an investor interest from SEO to an app store to an app to a venture capitalist to a deposit to a commission back to the affiliate. Those are the main industries right now. We've all tried dating. Dating websites don't necessarily get the returns, at least in a consolidated way that we enjoy with gaming. But yeah, I would tend to say gaming first, finance, PropTech is starting to look. There's always something else around the horizon.
Are any of you guys looking at crypto assets? Obviously, there's been a huge amount of interest in the crypto community to invest in gaming ICOs, or initial coin offerings. Have you guys looked at a lot of or any crypto businesses, crypto assets, and acquired or invested in any?
So I'll give the broker's perspective before I'll let the buyers talk. We turn away a lot of crypto-based affiliate sites because A, they're starting to be blacklisted by virtually every search engine on the planet, and B, they tend to be what essentially is known as HIPs, or high-yield investment programs. High-yield investment programs are Ponzi schemes. You don't necessarily have your name behind it, especially if you're a public company. That said, there are crypto assets, but they tend to be more on the regulated side, so less to do with affiliation and more to do with casinos or sportsbook. Those are lucrative because the way Bitcoin's working right now, if you can call up a low peak, you can buy at that level, and essentially then you get a commission for doing so. But at least from our perspective, we don't necessarily see that much of interest in crypto-based affiliation, if that makes sense. I don't know what you guys think.
We're not looking at crypto at all, but just to pick up on Michael's last question about outside interest in the sector, basically big investors coming in and acquiring, doing billion-dollar deals to buy the biggest assets in the business. We haven't seen anything like that yet, and I think that might be changing because of this U.S. situation. So you've got a lot of billion-dollar plus U.S. media companies, and there are even a handful of billion-dollar plus U.S. performance marketing companies which have managed to achieve that scale without ever sending a player on rev share to an online casino. So when they kind of discover the power of the gambling affiliation model, I think it'd be fairly hard for them to ignore that. So it's a very curious space. It's pure speculation, but I think in the future we may see some very keen interest from very, very large media companies coming in from outside the space.
Going to sell to Disney and Mickey Mouse. Do we have any final questions? We've only had one question. Yes, Mr. Galanis.
What we're seeing in the operator space, take GBC and Ladbrokes, take PokerStars Group and Sky Bet, mega mergers. That's happening for a variety of reasons. You might not answer this question honestly, but can you envisage, either yourself or one of your competitors set up there, looking at a mega merger with each other? Is that something that's likely to happen, do you think, anytime soon?
I'll pass the mic.
That's rubbish.
We're opportunistic. That's all I say. But on the operator space, there's so many operators. So at the moment, we don't see an issue with that mega merger or similar ones.
How does a mega merger affect your business? Clearly, you have two different affiliate accounts. You have two different rates. You have hundreds of sites that are sending traffic to both individual sites that are about to merge. Then, whoop, they merge. And then you get a call that says, okay, well, we have to discuss our affiliate rev shares. We're sending twice as many people now from one group. We have different rates that we're paying you. How do you deal with that? I mean, that must have a negative impact on your business when your customers essentially go through a merger.
No, I mean, but before they end up looking through the affiliate account, it's going to take them years. It's not a quick thing, but they do, and then it's either they get the traffic or they don't get the traffic, and then we might anyway end up getting a better deal for us, for our group. So so far it's not been a.
So whatever happens, punish them. Johan, you had something to add?
Yeah, well, we've seen some major operators over the last years, putting up the admin fees, make it more or less impossible to get a good deal with them. But I think most of affiliates, both small and large ones, are quite united, and we communicate. So far, all operators has been dependent on our traffic, so I don't see it as a big risk, even if you have these really big mergers.
Yeah, it hasn't affected our business at all. I mean, it might even be a good thing because you get a bigger, stronger relationship with a bigger, stronger group. They still want as much traffic as possible. They still operate multiple brands. They want to keep all this stuff going. It's in their best interest anyways, so it's really not an issue.
Well, this is a great question to end on because here we are in the Scandinavian market. We're assuming post-re-regulation in Sweden, we're going to see some M&A activity. And the good news seems to be that from these guys' experience, that's not going to negatively affect your businesses. Ladies and gentlemen, on that note, a big round of applause for our panel. Thank you very much, gentlemen. And now we have time for a break.